The moment you turn 70 and a half, the IRS quietly unlocks 7 provisions that can save you thousands of dollars per year in taxes. Not next year, not when RMDs start, right now at 70 and a half. And the vast majority of retirees will never use a single one of them because nobody explains that the rules change at this exact age. Most people think 70 and a half is meaningless. They think the important ages are 59 and a half when the early withdrawal penalty disappears, 62 when Social Security becomes available, 65 when Medicare starts, and 73 or when RMDs begin. Those ages get all the attention. 70 and a half gets ignored, and that is a mistake that costs retirees real money every year they miss it. Today, I'm going to walk you through all 7 provisions. Each one reduces your taxes, protects your Social Security from being pushed into the taxable zone, or shields you from Medicare surcharges. Some of them you can set up in 15 minutes. One of them can save you more than every other tax strategy in retirement combined. And the window for using some of them closes the moment RMDs start. Before I get into it, I need to be clear. I'm not a lawyer. I'm not a CPA. I'm not a financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. My name is Ivy, and if you are new here, this channel is for one specific group: retirees and pre-retirees over 60 who want to understand how the IRS actually works in retirement. Not the version your brokerage puts in the newsletter, the real version with real numbers in plain English. If that sounds like you, subscribe right now because the video I'm putting out next week is going to show you exactly what the IRS lets you do at 59 and a half, and that one could change your timeline. Drop a comment right now. Are you over 70 and a half? Just yes or no. I read every single comment, and the split between yes and no is going to determine whether my follow-up video focuses on how to use these provisions or how to prepare for them before you get there. 2 seconds, do it now. Let us get into it. Number 1, the qualified charitable distribution. This is the single most powerful tax tool available to any retiree over 70 and a half. And most people either do not know it exists or do not understand how valuable it is. Starting at exactly 70 and a half, you can transfer money directly from your traditional IRA to a qualified 501c3 charity. That transfer is called a qualified charitable distribution, or QCD. The maximum for 2026 is $111,000 per person. If you are married and both over 70 and a half, you and your spouse can each do $111,000 from your own IRAs for a combined $222,000. Here is what makes the QCD so powerful. The money goes directly from your IRA custodian to the charity. It never touches your bank account. It never appears on your tax return as income. It does not increase your adjusted gross income. It does not increase your provisional income. It does not push your Social Security into the taxable zone. It does not trigger Medicare surcharges. It is completely invisible to every tax calculation the IRS runs on your return. And once you reach the age when RMDs start, the QCD counts towards satisfying your required minimum distribution. So, instead of taking $15,000 out of your IRA, paying tax on it, and then writing a check to charity from your bank account, you send that $15,000 directly from the IRA to the charity. The RMD is satisfied, the tax is zero, the charitable impact is the same. The only difference is that the IRS gets nothing. Compare the two approaches. Without a QCD, you take a $15,000 RMD. It shows up as income. It pushes your provisional income higher. Up to 85% of your Social Security becomes taxable. At a 12% bracket, the tax on the RMD itself is about $1,800. Plus, the additional tax on the Social Security cascade is another $500 to $1,000. Total tax cost of donating $15,000 to charity the normal way, approximately $2,300 to $2,800. With a QCD, the total tax cost of donating the same $15,000 to the same charity, zero. You save $2,300 to $2,800 by changing how the money traveled from your IRA to the charity. Same donation, same charity, same amount, different route. Thousands saved. If you give to charity in any amount from $500 to your church to $50,000 to your alma mater and you are over 70 and a half and you're not routing it through a QCD, you are handing the IRS money you do not need to hand them. Call your IRA custodian tomorrow. Fidelity, Schwab, Vanguard, they all make this easy. You fill out a form, name the charity, and they send the check directly. It takes 15 minutes to set up, and it saves you real money every year for the rest of your life. Let me give you a concrete example so you see the full impact. A married couple, both 72, they give $8,000 per year to their church and $2,000 to a local food bank. Total charitable giving, $10,000 per year. They have been writing checks from their bank account for 20 years. Their income is Social Security of $38,000, IRA withdrawals of $25,000, and savings interest of $3,000. The provisional income is $25,000 plus $3,000 plus $19,000, which is half their Social Security. That equals $47,000. Above the $44,000 joint threshold, 85% of their Social Security is taxable. Approximately $21,140 of their Social Security is added to their taxable income. Now, watch what happens when they route the $10,000 in charitable giving through QCDs instead of bank account checks. They withdraw $15,000 from the IRA for living expenses instead of $25,000, and the other $10,000 goes directly from the IRA to the church and the food bank as QCDs. Their adjusted gross income drops by $10,000. Their provisional income drops from $47,000 to $37,000. They slide from the 85% zone into the 50% zone. The taxable portion of their Social Security drops from $21,840 to approximately $5,000. Their federal tax drops by approximately $2,000. They gave the same $10,000 to the same charities. Their lifestyle did not change. They just changed the route the money took, and that route change saved them $2,000 per year. Over 10 years, that is $20,000 on a $10,000 annual donation. There are 3 common mistakes people make with QCDs. First, they have the IRA custodian send the money to them and then they write the check to charity. That does not qualify. The money must go directly from the custodian to the charity. You never touch it. Second, they try to use a QCD with a donor-advised fund. Donor-advised funds do not qualify for QCDs. The money must go to an operating 501c on 3 charity. Third, they make the QCD one day before they turn 70 and a half. The IRS is strict. You must be 70 and a half on the day the distribution is made. Not 69 and 11 months, not 70 and 5 months. 70 and a half. Check your exact date before your first QCD. Did you know about QCDs before this video? Drop yes or no in the comments. I'm genuinely curious because this is the provision that saves more money than any other for retirees who give to charity, and most people have never heard the term. Number 2, the one-time QCD to a Charitable Remainder Trust or Charitable Gift Annuity. This one is new. The Secure 2.0 Act created a provision that allows you to make a one-time QCD of up to $55,000 from your IRA to fund either a Charitable Remainder Unit Trust, a Charitable Remainder Annuity Trust, or Charitable Gift Annuity. This is a lifetime limit, meaning you can only do it once. Here is why this matters. A charitable gift annuity or a charitable remainder trust pays you income for the rest of your life, and then the remaining assets go to the charity when you die. Normally, funding one of these with IRA money would require you to withdraw the funds, pay income tax on the withdrawal, and then contribute the after-tax amount. With this provision, you fund it directly from the IRA through a QCD. No income tax on the transfer. The charity gets funded. You get a lifetime income stream. The IRS gets nothing on the initial transfer. On $55,000, the tax savings on the transfer alone at a 22% rate is $12,100. Plus, you avoid the Social Security cascade and IRMA exposure that the withdrawal would have triggered. The total tax benefit can exceed $15,000 on this transaction. This is not for everyone. It requires working with a charity that offers gift annuities and understanding the payout rates and terms. But for retirees who are already charitably inclined and have large traditional IRAs, It is one of the most tax-efficient ways to create guaranteed income while supporting a cause you care about. Number 3, the pre-RMD IRA reduction window. This is the provision that most retirees completely miss because they do not understand the calendar. A QCD start at 70 and a half. RMDs do not start until 73 if you were born before 1960 or 75 if you were born in 1960 or later. The gap between 70 and a half and the start of RMDs is a window of 2.5 to 4.5 years, where you can use QCDs to reduce your IRA balance before the IRS starts forcing money out. Why does this matter? Because RMDs are calculated based on your IRA balance as of December 31st of the prior year. The higher that balance, the higher the forced withdrawal. The higher the withdrawal, the more Social Security gets taxed, the more likely you are to trigger IRMA, and the higher your effective tax rate. If you use QCDs during the pre-RMD window to reduce your IRA balance by $50,000 to $100,000, your future RMDs shrink proportionally. On a reduction of $100,000, your first RMD drops by approximately $4,000 per year. That $4,000 less enforced income keeps your provisional income lower, keeps your Social Security in a lower taxation zone, and potentially keeps you below the RMD threshold. The pre-RMD window is finite. Once RMDs start, you can still do QCDs, but the first dollars out of your IRA must satisfy the RMD before any additional QCD counts. The strategic advantage of reducing the balance before the clock starts ticking is enormous, and most people do not even know the window exists. Let me show you the math on this. A retiree turns 70 and 1-2 in 2026 with a traditional IRA of $500,000. RMDs will start at 75 because she was born in 1960 or later. She has 4 and 1-2 years in the pre-RMD window. If she does QCDs of $15,000 per year for 4 years, she reduces the IRA by $60,000. At 75, her balance is approximately $510,000 with growth instead of $570,000. Her first RMD drops from approximately $23,070 to approximately $20,732. That is approximately $2,438 less in forced taxable income every year for the rest of her life. At the 12% bracket, that saves her approximately $293 per year in direct tax on the RMD, but the cascade effect on Social Security taxation saves her an additional $400 to $600 per year. Combined annual savings approximately $700 to $900. Over 20 years, that is $14,000 to $18,000 saved all because she used the pre-RMD window to reduce her balance by $60,000 through QCDs that she was going to make anyway. Number 4, the last Roth conversion window before RMDs complicate everything. If you are 70 and 1-2, you have between clears throat 2 and 1-2 and 4 and 1-2 years before RMDs begin, depending on your birth year. This is the tail end of the gap years, and every year of conversion space that remains is precious. Once RMDs start, Roth conversions do not stop being possible, but they become much harder to execute efficiently. Your RMD must be taken first before any conversion. That RMD fills the lower tax brackets. The conversion then stacks on top, often landing in the 22% bracket or higher. At 70 and 1-2, if your income is controlled, you may still have room in the 12% bracket to convert $30,000 to $50,000 per year. At 73 or 75, when the RMD fills $15,000 to $25,000 of that bracket space, your conversion room at 12% shrinks dramatically. The math is simple. Every dollar you convert at 12% now saves you 10 to 18% points on that dollar later, when it would have come out as an RMD at 22 to 30% effective rate, including the Social Security cascade. On a $50,000 conversion, that is $5,000 to $9,000 in lifetime tax savings per year of conversion. If you are 70 and 1-2 and you have not started Roth conversions, you're in the last window where the math works in your favor. After RMDs begin, the window does not close completely, but the benefit shrinks every year. Let me show you why the math changes so dramatically once RMDs start. At 70 and 1-2 with no RMDs yet, a single filer with Social Security of $30,000 and $2,000 in savings interest has a taxable income after the standard deduction of $18,150 of approximately $13,850. She is in the 12% bracket with over $36,000 of room before hitting 22%. She can convert $36,000 at 12%. Total conversion tax, approximately $4,320. Now fast forward to 75 when her RMD starts. Same Social Security, same savings interest, but now her RMD of $18,000 is forced into the brackets first. After the standard deduction, her taxable income before any conversion is approximately $31,150. She has only $18,550 of 12% space left. Her conversion capacity at the lowest rate just dropped by half, and it gets worse every year. At 80, the RMD percentage is higher. At 85, higher still. By 85, the RMD alone may fill most of the 12% bracket, leaving almost no room for conversions at favorable rates. There is also the IRMA consideration. Every dollar of Roth conversion counts toward your modified adjusted gross income. At 70 and 1-2, if your MAGI is below $109,000 as a single filer, you can convert up to that threshold without triggering Medicare surcharges. But remember the 2-year look-back. A conversion you do at 70 and 1-2 in 2026 affects your Medicare premiums at 72 and 1-2 in 2028. Plan the conversion amount with one eye on the tax bracket and the other eye on the IRMA tier. The conversion still almost always makes sense, but you need to know the full cost. Number 5. The new code Y on your 1099-R. This one is not a strategy. It is a reporting change that solves a problem retirees have been dealing with for years, and almost nobody knows about it. Starting with the 2025 tax year, the IRS introduced Code Y for Box 7 of Form 1099-R. This code specifically identifies a distribution as a qualified charitable distribution. Before this code existed, QCDs were reported as regular distributions on your 1099-R. Your tax software saw them as taxable income. You had to manually exclude them on your return, and if your software or your preparer did not handle it correctly, you paid tax on money that should have been tax-free. This happened constantly. Retirees would do a QCD, think they were done, and then discover in April that their tax software included the distribution as income. They overpaid. Some of them never caught it. Code Y eliminates that problem. When your IRA custodian sends the 1099-R with Code Y in Box 7, your tax software knows automatically that this distribution was a QCD and excludes it from income. No manual adjustment, no room for error. If you did a QCD in 2025 or earlier and your preparer included it as taxable income, you may have overpaid. You can file an amended return within 3 years to fix it. Check your 1099-R from 2025. If the QCD is listed with Code Y and it was included in your taxable income on your return, that is money the IRS owes you back. If you have made it this far in the video, you're exactly the kind of person this channel is built for. Hit the like button right now. It takes 1 second and it tells YouTube to show this to more retirees who need to hear this. And if you are not subscribed, do it now. I see your comments every day. The most common one is, how do I figure out what this means for my situation? That is why I built a guide that teaches you how to use AI tools to answer any retirement tax question with your own numbers in minutes. If these videos are valuable to you, that guide is the next step. Thea's Guide. Shop link in the description. Number 6. Social Security Maximum Benefit plus Provisional Income Management. If you delayed Social Security until 70, your benefit is now at its maximum. For every year you delayed past your full retirement age, the benefit grew by approximately 8%. At 70, your benefit is 132% of your full retirement age amount. That is locked in permanently with cost of living adjustments on top. At 70 and 1-2, you have been collecting that maximum benefit for 6 months. And now the question shifts from when should I claim to how do I protect what I am getting from being taxed? The answer is provisional income management. And 70 and 1/2 is the age where this becomes the most important calculation in your financial life. Your provisional income is your adjusted gross income plus any tax-exempt interest plus half your Social Security. If you are a single filer and your provisional income exceeds $34,000, up to 85% of your Social Security is taxable. For a married couple filing jointly, the threshold is $44,000. At 70 and 1/2 with a maximum Social Security benefit of approximately $40,000 per year, half of that is $20,000. That $20,000 goes into your provisional income before you have withdrawn a single dollar from any other account. You only have $14,000 of breathing room before you cross the $34,000 threshold as a single filer. This means every dollar of additional income matters enormously. A $10,000 IRA withdrawal pushes you to $34,000 and triggers the 85% zone. A $10,000 QCD instead of an IRA withdrawal keeps you at $24,000, well below the threshold. The QCD kept your Social Security tax-free. The IRA withdrawal would have made $20,000 of your Social Security taxable. At a 12% rate, that is $2,400 saved every year from one decision about how to move $10,000. This is why 70 and 1/2 is so important. The QCD becomes available at exactly the age when provisional income management becomes critical. The two provisions work together perfectly, and the IRS does not explain the connection. Number 7. The senior bonus deduction stacked with QCD and Roth income. The One Big Beautiful Bill, signed into law in 2025, created a $6,000 deduction for taxpayers 65 and older, $12,000 for a married couple where both are 65 or older. The income phase-out starts at $75,000 for single filers and $150,000 for married filing jointly. At 70 and 1/2, you're well past 65. The deduction applies to you, but the real power is not the deduction by itself. It is the deduction stacked with QCDs and Roth withdrawals. Here is the stack. You need $50,000 to live. Social Security covers $30,000. You need $20,000 more. You pull $10,000 from a Roth IRA, tax-free, invisible to the IRS. You do a $10,000 QCD from your traditional IRA to your church. Satisfies part of your charitable giving, invisible to the IRS. Your adjusted gross income is just your Social Security. Your provisional income is $15,000, below the $25,000 threshold. 0% of your Social Security is taxed. The senior bonus deduction reduces your taxable income further. Your federal tax bill is essentially zero. You lived on $50,000 and paid zero in federal income tax, legally, because you stacked 3 provisions that all become available by 70 and a half. Now, compare that to the retiree who pulls the full $20,000 from a traditional IRA instead of splitting it between Roth and QCD. Their provisional income jumps to $35,000. They cross the $34,000 threshold. 85% of their Social Security is taxable. Their federal tax bill is approximately $2,000 to $3,000. Same income, same lifestyle. One retiree pays zero. The other pays $3,000. The difference is knowing about 3 provisions and stacking them. The IRS will never explain this combination to you. Your tax software will never suggest it. Most tax preparers will never model it unless you ask. And if you live in one of the 8 states that still tax Social Security in 2026, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, the stacking strategy saves you at the state level too. Every dollar of Social Security that stays out of the taxable zone is a dollar that your state cannot touch either. In Minnesota, where the state exemption phases out at higher incomes, keeping your provisional income low through QCDs and Roth withdrawals can mean the difference between a full state exemption and no exemption at all. One critical warning about the senior bonus deduction: it is temporary. It runs from 2025 through 2028 only. After 2028, unless Congress extends it, the deduction disappears. That means you have 3 more tax years to use it. If you are 70 and a half right now in 2026, you have 2026, 2027, and 2028. 3 years. At $12,000 per year for a couple, that is $36,000 in deductions. saving you approximately $4,320 at the 12% rate. After 2028, that savings is gone. Use every year of it. Let me bring all 7 together. At 70 and a half, the IRS unlocks the QCD, which lets you donate up to $111,000 per year from your IRA tax-free. It unlocks the one-time QCD to a Charitable Remainder Trust or Gift Annuity for up to $55,000. It opens the pre-RMD window where QCDs can shrink your IRA before forced withdrawals begin. It gives you the last clean Roth conversion window before RMDs compress your bracket space. It introduces code Y on your 1099-R so your QCDs are reported correctly for the first time. It makes provisional income management critical because your maximum Social Security benefit is now flowing, and it lets you stack the senior bonus deduction with QCDs and Roth withdrawals to potentially reach a 0% effective tax rate. 7 provisions, all available right now if you are 70 and 102 or older, and the IRS will not explain a single one of them to you. Here is what I want you to do right now. 3 things. First, if you give to charity in any amount and you're over 70 and 1-2, call your IRA custodian this week and set up a QCD. Fidelity, Schwab, Vanguard, all of them have a simple form. It takes 15 minutes. Start with your next charitable gift and route it through the IRA instead of writing a check. Second, calculate your provisional income. Take your AGI, add any tax-exempt interest, add half your Social Security. Where do you land relative to the $25,000 and $34,000 thresholds? If you are above $34,000, look at how much of that income could be replaced with Roth withdrawals or QCDs. That is the money you can claw back from the IRS. Third, check your 2025 1099-R. If you did a QCD last year, look for code Y in box 7. If it is there and your return included that amount as taxable income, you overpaid. File an amended return. Drop a comment and tell me which of the 7 provisions surprised you the most. Just the number, 1 through 7. That number tells me exactly what to cover in the next deep dive video, and the most common answer becomes next week's full episode. If this helped you, hit like. Subscribe if you have not already. I make videos like this every week. And if you have any specific question about your own situation, my guide at theisguide.shop teaches you how to answer it yourself using AI. Link in the description. I will see you in the next one.